In this video, I'm going to show you the best Canadian Growth ETF to invest in. Currently, many platforms offer growth ETFs to Canadians. Inside these specific growth ETFs represent a combination of ETFs from their own platform's library. Besides being a growth vehicle, the purpose of these ETFs is to provide diversity of growth by investing in different stocks and bonds of different countries and industries. When it comes down to it, the platform with a better combination of ETFs inside the growth portfolio is the winner. In Canada, the notable platforms offering Canadian growth ETFs include Vanguard, Blackrock iShares, BMO and Horizons. To make our comparison fair, Canadian growth ETFs are separated into two buckets. The first bucket is the 80-20 ETFs, which essentially means portfolios build 80% equity and 20% bonds. In other words, it's 80% growth by stocks and 20% defense by fixed income. This group has gotten popular with Canadian investors who want a steadier approach to stock market growth and volatility, all without the stress of losing most of it in a stock market crash scenario. Personally, I think this group would be most ideal for investors who have an intention of selling and withdrawing their funds in a short time frame. When a market crash or correction happens and funds are needed, some people may be forced to sell at a bottom. This group, because of the safety net of the 20% bond portion, will do better against the second group during shorter downturn moments in time. The second bucket are those with 100% equity or just 100% in stocks. Investors who intend on holding their investments over long periods of time for the most growth and can mentally handle the larger stock market swings in the short term will find this group the most ideal. Over long periods of time, the stock market trends higher, and as a result, the second group always performs better. But not all investors can mentally handle these swings and may find themselves panic selling at a stock market bottom. So only when you have a never sell type of attitude, only then you can see these group of ETFs work in your favor over long periods of time. So here's a list of all major Canadian growth ETFs split by the two buckets. I also have some benchmarks like the S&P 500 to see if their performance is good enough. Let's talk about the 80-20 group first. There are three ETFs and include the Vanguard Growth ETF, or VGROW, iShares Core Growth ETF, XGROW, and BMO Growth ETF, ZGROW. Besides the 80-20 orientation, what's common about these Canadian growth ETFs is that they try to invest around the world. So as a basic benchmark measurement, I try to create my own by using the iShares MSCI World Index ETF to represent our 80% global stock portion, and the iShares Global Government Bond Index ETF for our 20% global fixed income portion. Let me quickly introduce each ETF and compare them. VGROW, the largest of the three ETFs, it has almost $1.7 billion in assets. Started in 2018, has an MER of 0.25% and a distribution yield at 1.9%. These are its ETF holdings inside. You get a diverse range of stocks and bonds from around the world. Here's how dividends have been paid since inception. You get pretty steady but inconsistent distributions every quarter. XGROW, the oldest of the three ETFs. It has around $550 million in assets. Started in 2007, has an MER of 0.2% and a distribution yield of 2%. These are its ETF holdings inside. Similar to the previous ETF, there's a diverse range of investments. Here's how dividends have been paid since inception. XGROW used to be monthly distributions and recently changed to quarterly payments since 2019. To get a closer view of just the quarterly payments, it's steady but inconsistent. ZGROW, the highest dividend yield of the three ETFs. It has around $66 million in assets. Started in 2019. Has an MER of 0.2% and distribution yield of 2.5%. These are its ETF holdings inside. From this set, you get a diverse range of stocks, but I found that of the bonds, it's actually 90% Canada. Here's how dividends have been paid since inception. Although there's not many years of data to work with, the quarterly distributions are the most steady of any ETF I talk about in this entire video. And based on 1 year of time, it has shown clear evidence of growth so far. XWD and XGGB. For my benchmark, the World Index ETF represents the largest stocks in developed countries, and the Global Government Bond ETF represents the bonds of governments around the world. They're both pretty large ETFs and have fairly balanced profiles, although a bit more expensive on the MER side. These are the ETF holdings inside the World Index, and here's the top governments that the bond ETF has exposure in. The majority of exposure is in the US for both stocks and bonds. Here are the distributions for the two ETFs. The World Index offers semi-annual distributions, and the government bond goes by monthly. The general trend is increasing from the stock side, and it's pretty stable for the bond side. Now let's compare the ETFs and also see which performed the best. Here are the profiles side by side. They're going to look really similar, but the simple differentiations are that I found the Vanguard ETF has the most assets, iShares was the oldest, and BMO had the highest dividend yield, and the benchmark is the easiest to understand. Here's how they compare by the geographies that they invest in. You'll find that the top 3 are very evenly spread between Canada, US, and international investments. Only the benchmark gives a more realistic sized distribution of the stocks and bonds from different geographies to the overall portfolio. Essentially, the benchmark gives a low exposure to Canada and focuses mostly on US and international, which are where the biggest companies and governments exist. I went one step further to break down how much the stocks and bonds are split amongst the different geographies. You'll find that the common percentage allocation between the 3 ETFs is that a majority of the portfolios is led by US stocks, followed by either Canadian or international stocks, and then finally Canadian bonds being the huge majority of the bonds. But from here, you can differentiate between them. Depending on what geographies you think is the highest growth area for the future, it might be a determining factor in which growth ETF to invest in. Vanguard has more Canadian stocks in the portfolio. iShares has more US stocks and also more total bonds, making 23% of the portfolio. BMO has the most international stocks and Canadian bonds, but no international bonds. And our benchmark has the most US stocks and little to no exposure to Canada. From a performance standpoint, I compared based on a 1, 3, 6, 12 month and common inception return on investment. In our case, the common inception point was February 2019, which was based on BMO's Growth ETF's inception date. From there, I found that the iShares Growth ETF was the best from all these dates, despite the fact that it had a 23% bond portfolio. If we use XGROW as a baseline measurement, in the near-term months, VGROW was pretty close, but it fell off in later time periods. In contrast, ZGROW had performance in the near-term months that were lower, but when given time, performance in the later time periods started to get fairly close. What this implies, for me at least, is VGROW and XGROW, since they were equal in recent months, were good on the rebound from the 2020 March bottom compared to ZGROW. But during periods of steady upward growth, then XGROW and ZGROW were pretty good, with ZGROW having the edge. When visualizing the 3 ETFs since their common inception point, here's how it looked like. I thought it was pretty interesting to see that BMO's ETF, or the green line, was always ahead of the iShares, the orange line, throughout time except for recent months. Overall, I expect fairly close performance by the 3 of them over time, but I would personally lean towards XGROW because of good performance in both the near and far term months, and if it could rebalance back up to an 80-20 stock portfolio to gear up growth. Now let's move to our 100% equity bucket, which is our even higher performing group. There are 4 ETFs and include the Vanguard All Equity ETF or VEQT, iShares Core Equity ETF XEQT, iShares Canadian Growth ETF XCG, and Horizons Growth TRI ETF HGROW. For my benchmark, I just use the iShares World Index ETF again, or XWD. As secondary benchmarks, I also compare to the S&P 500 and Nasdaq 100 Index, which are VFV and ZNQ. Let me quickly introduce each ETF and then compare them. VEQT, the largest of the 4 ETFs. It has $508 million in assets, started in 2019. Has an MER of 0.25% and distribution yield at 1.3%. These are the ETF holdings inside. They're the same as VGROW, but the equity is re-rated higher without any bonds. Here's how dividends have been paid since inception. The payments were made annually, and there were 2 payments so far. XEQT, the highest dividend of the 4 ETFs. It has $174 million in assets, started in 2019, has an MER of 0.2% and distribution yield at 1.9%. These are the ETF holdings inside. They're the same as XGROW, but the equity is re-rated higher without any bonds. Here's how dividends have been paid since inception. The payments were made quarterly, and there wasn't any sort of consistency or clear growth trajectory when even comparing quarters on a year-over-year basis. XCG, the peer Canada and the oldest of the 4 ETFs. It has $64 million in assets, started in 2006, has an MER of 0.55% and distribution yield at 1.7%. These are its holdings inside. This is the only growth ETF from a list that has individual stocks inside instead of other ETFs. Here's how dividends have been paid since inception. It has been steadily growing over time, although the quarters aren't very consistent. Kicking the outlier for a closer view, the dividends have been showing growth since 2015 and have tripled from that point. That implies a growth rate of almost 27% per year. HGROW, the most US focused of the 4 ETFs. It has $16 million in assets, started in 2019, has an MER of 0.16% and a distribution yield of 0.2%. These are its ETF holdings inside. Some distinct attributes of HGROW is that it invests in the Nasdaq, and for international stocks, they only pick from developed countries. Other ETFs have emerging market countries. Here's how the dividends have been paid since inception. The dividends are made annually, so there's not a lot of data to work with. The big difference between the 2 years is the late start in 2019, which gives off a lower first-year payment for comparison. Our 2 secondary benchmarks are the S&P 500 and Nasdaq 100 indexes. The S&P 500 represents 500 of America's largest companies in various industries. The Nasdaq 100 represents 100 of America's largest and fastest growing companies in various industries. Here are the top holdings inside. One thing you will notice is that they have fairly similar names at the top, like Apple, Microsoft, Amazon, and Facebook, but just at different weights. Here's how dividends have been paid since inception. The overall trend for dividends is increasing. Let's compare the ETFs and the benchmark measures. Here are their profiles side by side. To quickly differentiate the growth ETFs, Vanguard is the biggest in assets. iShares Core Equity has the highest dividend yield. iShares Canadian Growth is oldest, and HGROW has the lowest MER. The three benchmarks are pretty easy to remember. Here's how they compare by the geographies that they invest in. With the exception of the iShares Canadian Growth ETF, which is purely Canadian companies, the rest of the ETFs, including the benchmarks, have the heaviest concentration in the US. VEQT is noticeably more concentrated in Canada than the remaining growth ETFs. XEQT gives more US and international. HGROW gives even more US, but nearly zero weighting Canadian exposure. Our three benchmark ETFs gives an even higher or pure exposure to the US. Here's how the ETFs compare from an industry exposure point of view. Technology, consumer discretionary, and industrials are examples of industries where many growth companies tend to come from. In contrast, financials and energy have been generally laggards in recent years from a growth angle. All the Canadian growth ETFs have technology as the highest exposure, followed by different combinations of other industries. Our two secondary benchmarks have even higher tech exposure than the rest of the ETFs. The Nasdaq 100 has almost half its holdings in technology and none in either financials and energy. All ETFs except for the Nasdaq had exposure to financials, but what stands out is that VEQT had the most. Also unique is that XCG has the most energy, while others don't have as much. From a performance standpoint, here's how the ETFs did. Most of the time periods show that HGROW was the best and XCG was worst amongst our four growth ETFs. When visualizing the three ETFs since their common inception point, here's how it looked like. When you exclude HGROW, the purple line at the top, the other ETFs are pretty close in performance. Going back to our table, excluding HGROW, the other ETFs since inception had very comparable, but just slightly lower performance to the benchmark World Index ETF. Interestingly, in recent months, there was some outperformance against the benchmark, but it still trailed behind over time. This implies that the rebound potential was stronger against the benchmark, but the steady periods of growth showed lesser performance. If I had to choose amongst these three growth ETFs, I would go with XEQT, given a lower financial and energy industry exposure, which mostly comes from a lower weight in Canada. But I personally think that the benchmark World Index ETF has the ability to maintain its outperformance over time against these three ETFs if it can simply manage to slash a high MER in half. Since the common inception point, our secondary benchmark, the Nasdaq 100, was distinctly the best from this table. HGROW was the second best, given that it also has a 23% weight in the Nasdaq 100 ETF as one of its holdings, so it naturally trailed the strong performance. The third best was the S&P 500, and a very big reason for its outperformance against the growth ETFs was because it has even more technology exposure and noticeably less financial and energy. Following the S&P 500, the next best in performance was the World Index, which has 66% of its portfolio in the S&P 500. So the common theme is that whatever portfolio has the highest US or technology exposure wins. But many investors are starting to think that these two factors are becoming overvalued and would prefer to see growth elsewhere. With just our list of Canadian growth ETFs, there's really no way to fully escape them, and the best option would be to lower the exposures. That would mean picking either XCG or VEQT. This would be increasing the exposures to Canada and international investments and slightly lessening technology in exchange for other industries. So that's all for now. If you enjoyed this video or learned something new, remember to like, subscribe, and turn on your notifications for new investment ideas in the future. Let me know in the comments below which growth ETF you invest in, and I'll see you next time.